Okay, let's do a quickie. Hardcore computers, only 15 marks. So therefore it's also, it's really not a huge exercise. Just get rid of this. Ignore value added tax. Hardcore computers was incorporated in 2006 and has a 30 June year end. Just like that one, thanks. The industry is continually evolving and it is essential that the company keeps up with the latest technical advancements. During the current year, Hardcore decided to expand the research and design division and issued additional shares to fund the expansion. Hardcore has the following authorized share capital: 8 million ordinary shares with no par value, 650,000 9% compulsory redeemable cumulative preference shares with a par value of R2.50 each, and 1,250,000 11% compulsory convertible non-cumulative preference shares with no par value. You have been requested to assist with the preparation of financial statements and have been provided the following extract out of the trial balance as at 30 June 2018. We are required to prepare the statement of changes in equity for Hardcore for the year ended 30 June 2018. So therefore, these balances should be more or less be closing balances and not opening balances. The following transactions occurred during the year and have already been accounted for in the figures. So that means that these transactions have already been included in these figures here. And then if you go down, they say the following transactions still need to be accounted for. So obviously, this was a preliminary trial balance. After these transactions, this first lot has been taken into account. This was the balances that I extract out of the general ledger. But then there was still something to do, and these 3 points here still had to be processed in order to get to the final trial balance. Good, so let's start with it. Now you should know that this cannot be opening balances. This that we've seen now can't be closing balances either, because there's some in-between transactions that still needs to be updated. So it is a sort of a middle-of-the-road final balance. On 1 November 2017, the Board of Directors allotted 450,000 shares at R3.75 per share, ordinary shares, and 150,000 11% compulsory convertible non-cumulative pref shares at R2.20 per share. 1 November 2017, does that fall in the current financial year? Yes, it does. So that happened during the year, and that transaction, the result of that, has already been included in that balance. But on the statement of changes in equity, we have to write it down. So issue of ordinary shares, 450,000 multiplied by R3.75, here it is. 450,000 times R3.75 gave you a proceeds of 1,687,500. Then the preference shares, 150,000 times R2.20 each. 150,000 times R2.20, so in our state capital, 11% convertible preference share column, 330,000 rand. Share issue costs amounting to 6,525 has been paid. Now, the clever guy, the accountant, took the full amount to the share premium expense account. Guys, share premium can never have an expense account. Why? Because share premium, the share issue costs can never go to an expense account, because share issue costs should be written off either against the capital of the shares issued or against retained earnings. So it was taken to an expense account when calculating the profit for the year. So clearly, twice, they told you that they took it to the income statement. It is the policy of Hardcore to account for share issue costs against retained earnings. So here they give me a profit before tax figure, and that profit before tax figure needs now to be adjusted with this share issue cost of 6525. So I'm going to add it to that amount, and I'm going to deduct the 6525 from my retained earnings. So 6525 from retained earnings. Retained earnings was 560,000 Rand. That was the figure before this share issue cost has been deducted from it. So therefore that figure as an opening balance is 100% correct, because there was no adjustments that was posted against retained earnings up to now. So that 560,000 is 100% to be shown as an opening balance. The investment account relates to shares held in Investor Limited. Now that is this one here. We have investments that cost financial assets, and that equals shares that we bought at 5.50 Rand each. So if the total amount of our investment account is 412,500 and we have bought those shares at 5.50 Rand each, it means that we have bought 75,000 shares. On 1 June 2018, a dividend of 80 cents per share was received. So what was the dividend that we have received? That equaled an amount of 60,000 Rand. And now this has already been accounted for. So this has already been included in our profit before tax figure up to that stage, because they say we have already been accounted for those transactions. Why then do I need to know that? Because for tax purposes, it's not a taxable income. It is the policy of Hardcore to disclose their land and buildings at fair value. So this has also been accounted for. On 1 May 2018, Mr. Evaluator revalued the land and buildings to be 20% higher than the previous revaluation performed. So the revaluation has also been recorded as yet, and there we have the balance after that has been recorded of 3960. So that 3960 is our closing balance. What we need is the movement for the year and the opening balance. Now they tell us that land and buildings 12,960. That is the closing balance of land and buildings. So, what here? 12,960 is a value which is 20% higher than the previous valuation. So that divided by 1.20, that will give us the value of that land and buildings before the revaluation took place. So how much was the revaluation now? It's 12,960 less 10,800. So the amount of the revaluation in the current year was 2,160,000. So then I can put that on my statement of changes in equity 2160, and I can work backwards now to the opening balance of 1.8 million Rand. Now, things that has not yet been accounted for. A final ordinary dividend of 90 cents per share was declared on the last day of the 2018 financial year, but has not yet been recorded. 25% is South African companies. The dividend is payable on 25 July. That doesn't matter. The fact of the matter is that we have declared the dividend on the last day of the financial year. So the commitment to pay the dividend originated on the last day of the financial year. So therefore we have to make provision for that. Now up to this stage, all included, there was a total of 3.7 million ordinary shares in issue. So if we want to work out the dividend, it's easy. 3.7 million ordinary shares multiplied by 90 cents will give us a total of 330,000. Now we know that if an ordinary dividend was declared, the preference dividends has also been declared. So therefore we have to work out the preference dividends. Now the first one will be on our redeemable cumulative preference shares, but that nothing happened to those shares during the year, and that is actually loan capital. So our interest, which has not yet been taken into consideration in our profit before tax, would be 9% of the million Rand. So interest on redeemable pref shares would have been 90,000 Rand, which we still have to account for. Then the last one is our compulsory convertible shares. Now, we had 1,992,500 at the stage before we have calculated any dividends or any further transactions. So if we go to your statement of changes in equity, you would have had our 330,000, which is the 150,000 shares issued at R2.20. And then here, I'm going to write it in here. Insert text box. There, the balance would have been 1,992,500. Oh, jene toch. So therefore I can work backwards to what the opening balance was supposed to be. So the opening balance would then be 1,992,500 less the 330,000, which gives me 1,662,500. Now, my dividend, I will come back to that one now. My dividend for the year would then have been on the 1,662,500 multiplied by 11% for the full year. So if I go to my dividend calculation, 1,662,500 times 11% for the full year of 182,875. On this additional share issue of 330,000, this share issue took place on the 1st of November. So from the 1st of November up to 30 June 2018, I have to calculate on the 330,000 times 11% times 8 months a dividend, which gives us 24,200. So the total dividend on our cumulative, non-cumulative convertible shares was 207,075. So there's our total dividend, 2,160,000 plus 207,075. Dividends was then against retained income in total 3,537,075. Now, simultaneously what I've done here, we have to do with our ordinary share capital in order to derive at the 11,375. If you go to your trial balance, then you will see that the balance up to this stage, as per your trial balance, was an amount equal to 13,062,500. Now that 13,062,500 minus this shares that I have actually issued here of 1,687,500 will then bring me back to my opening balance of my ordinary share capital of 11,375,000. Great. Now the only thing that remains is our profit after tax. Let's see whether there's any other adjustments. Immediately after the dividend was declared, the board of directors was given approval to convert 40% of the 11% compulsory convertible non-cumulative preference shares to ordinary shares. The conversion price was R4 per share. So also at year end, basically, what I should have said, simultaneously with the dividend, which was declared, then they have converted 40% of these shares into ordinary shares. So we have to account for it in our current financial year. So conversion of shares is going to be 1,992,500, which is the balance at that stage, multiplied by 40% equals 797,000. And what do I do with the conversion? I move one class capital into another class capital. So I just move that out of our convertible shares into our ordinary shares. And it was at R4, but we don't need to calculate the number of shares because we're not going to use that. Great, so the other thing is our profit after tax. So let's have a look at our profit after tax. That is the only thing that we still have to do. Obviously, where are we going to start? We are going to start with our preliminary profit before tax figure. Then we have to account for the share issue cost, which was incorrectly calculated against profit, so we're going to add it back. And then we have to account for the interest on the redeemable pref shares. So we have to deduct that. Let's go and have a look at our profit calculation. Profit before tax, the 7.4 million, less the interest on the redeemable shares, 90,000, plus the share issue cost, that gives us 65,5, give us profit before tax of 7370525. Now we're going to do our tax calc. Where does our tax calc start? It starts with our income before tax. So 7370525. The only item which is differently treated for tax purposes than for accounting purposes is that dividends received is a non-taxable income. So that dividends that we've worked out there, which we have received, the 60,000 Rand here, investment income, that we have to take out of our accounting profit in order to determine our taxable profit. So we're going to deduct that, and then that will give us then here taxable income of 7130525. Our tax is 28% of taxable income, which is 2046,947. And that is the amount that we transfer back into our income statement, 2046,947, in order to derive at our profit after tax of 5323578. And that is the amount that we're going to post against retained earnings on our statement of changes in equity. And then we're done.